The economy is continuing to grow. We're seeing a substantial number of jobs created each month. Not quite as many as in the last 2 years, but still far from recession levels. And similarly, spending by individuals, by businesses, and by government is well above what you would expect if the economy were going to hit either a so-called soft landing or an actual recession. Inflation has stayed higher than the Fed would like, and I think that they will be keeping their short-term interest rate target elevated for longer than most people expect. It seems like the consensus, including among the Fed governors and bank presidents themselves, is that they'll be cutting rates twice this year. I don't think that's going to happen before December, and maybe not until 2025. What are the implications for construction? There's still a lot of demand, particularly for data centers and manufacturing plants, and growing demand for renewable energy projects, whether it's solar fields, transmission lines, or even charging for vehicles, and also an increasing number of infrastructure projects finally hitting the market. However, those elevated interest rates mean that developers can no longer afford to pay the higher financing costs and higher construction costs that they need to recapture through higher rents. In fact, rents have flattened or are starting to fall for multifamily and for warehouse projects in many parts of the country. And the office market is truly dismal. So I do think income-producing properties are likely to be in decline in the next year and a half, but that will be outweighed by the growth in other kinds of construction. The major concern continues to be finding enough workers and what it's going to cost, both for workers and for materials.
We saw in the month of May that bid prices remained relatively stable while new non-residential input prices declined. Now, there are certain materials such as diesel which fell, while others such as aluminum, copper, and certain structural materials increased. Construction costs, specifically labor costs, have increased. We see that non-residential construction average hourly earnings increased by 6.4% for the month. This, compared to the private sector average hourly earnings, is much higher, which are 4.1%. Something that we have on the horizon is our workforce development survey, which we implore contractors to take because it's really their opportunity to tell us what's happening in their company. And results of the survey can be used to benchmark across other construction companies. Results will be released the week before Labor Day. This is your opportunity to take it.
Overall, I think it's going to be a good year ahead for non-residential construction. Contractors should be doing well if they can get materials at a cost that they can afford and can find the labor they needed to do projects.